Nitin Bhasin with us, Head Institutional Equities at Ambit. Nitin, great to have you on. Thank you so much for your time with us this morning, which is turning out to be a pretty good one. After a while, markets in good cheer. Do you put it down to the Bihar effect, closing in on a trade deal, or just the feeling and realization that corporate results and corporate performance has been maybe better than expected?
Good morning, Tamanna. Thanks for having me here on the show. Clearly, I think I would agree with the last point that you just made. Getting into the financial quarter results, we were also thinking that, how to look at the numbers, but perhaps what we saw is more beats than misses. Mid cap, small cap, large cap, and we see everywhere slightly better numbers in terms of beats, whether it is a 1% or whether it is a 3%. So hence, I would say corporate financial numbers is what is one thing. Number two, I would actually also follow it up with possible chances of a trade tariff reversals or reductions in the US. I think I would add those two things to the buoyancy today.
Not so much to results. Okay, that was anyway, if there was a negative surprise, it would have had more impact than anything else. Let me come in a little more detail to you, Nitin, on the numbers part of it and the corporate action that we have seen, or at least corporate performance that we have seen. What, in your view, has been the big positive surprise and the biggest disappointment?
Without getting into the stocks, I think the biggest surprise for me was mid caps posting in closer to about, as a cohort, as an index, about 13 to 14% earnings growth for this particular quarter. At the same point in time, looking at the small caps also posting in about 11% to 12% sort of earnings growth for this quarter. I would think the mid cap and the small caps posting such reasonably double-digit PAT growth has been one of the biggest surprises for us. And alongside, what we have noticed is that the flows in India have perhaps changed the color also in terms of how the market participants, whether it is FIs or DIs, are loading up on or adding certain sectors like oil and gas. I think I would say from the earnings, as I said, the cohort has surprised. At the same point in time, the flows, we'll come to that little later, that has surprised. And I'll add last thing to this. In the last 1 month, getting into the festival season, all of us were glued on how the urban consumption would actually pan out. The urban consumption was better than expected in the festive season. So those last 1 month have been surprises for me.
Got it. Well, Nitin, good morning. Neeraj here. Did the commentary that you by and large heard about the immediate quarter ahead, particularly either from consumption or consumer financing or some such, lead you to believe that quarter 3 and quarter 4 have a high probability of a strong earnings growth? Because almost everybody seems to be telling us, rightly so, that GST is not just an immediacy effect. It will last for a bit longer.
Yeah, you can see that in the very recent times, the credit growth has finally inched up in excess of deposit growth. And even our bank's analyst believes that you could actually have the credit growth start looking up by the end of the year, closer to about 12% or so. So clearly it appears that whether it was consumption or credit coming back, and a lot of that is, again, remember, not wholesale lending or not the lending for, let's say, projects that much, but it's more like consumption or, let's say, retail loans. That clearly shows you that consumption is looking up, some green shoots visible more, or let's say acceleration in the improvement trends visible more than one could have said about 3 months back. That's how I would say. But the only thing I'll add over here is everything is not very similar, Neeraj. You saw the numbers for real estate, they looked good for this quarter, but the numbers for hotel industry, they didn't look that good for this particular quarter. Yeah. Hotels are looking up really well, but that's not what's happening. It was becoming a trend. So hence, I would say there are still inconsistencies in consumption. But one cannot say everything is firing in one direction. But if there were any worries about either stagnation or deceleration, I would put them behind today. So I would say slightly better.
You are sounding bullish, Nitin. Would it be fair to say, I mean, and again, I heard you say that you're more enthused by the broader market results, But could this plus a potential trade deal revival, Bihar elections, what have you, mean that the headline numbers or headline indices too over the course of the next 6, 9, 12 months stay anchored or move higher versus going lower?
As market observers and also trying to make sense of the market, which is so difficult, I would still hold to my base view that 1 year back we went into this cycle of fragmentation and concentration. You already seen about 12, 13 months of Nifty not generating any material returns, but also not losing money, whereas small cap and mid cap as a cohort of indices, which is not the best way to investing, but to watch the trend, we've seen that the large caps have held up. Companies like Reliance and SBI and the HDFCs giving you about mid-teen returns in the last 1 year as compared to many of the cohort of small cap and mid cap. That has been our call, and I still would maintain that call. Next 1 year, market can go sideways. It's a stock picker market. Large caps preferred over mid cap, whether it is small or mid. I would still maintain that. But in the near term, the next 1 or 2 months, because market also looks in the recent past for trends. We have noticed such trends of consumption, of whether it is the trade deal or whether it was urban consumption. And on top of that, even adding indicators like huge shorts built by the FIs in India. That clearly shows you when such big shorts are built up. We haven't seen, as per our team, the markets actually give away. So hence, and also I'll add last thing to this, Neeraj, is look at where the money is going. The domestics are putting in money in BFSI, so are the FIs, and domestics and FIs are also putting in money in oil and gas, large caps, where there is a valuation comfort and a large aggregate pool of profit.
Domestics are also putting in money, Nitin, in the primary market. As we wrap up this conversation, I'm tempted to ask your view there. A recent note by Ambit, a sell call actually on company before it listed, grabbed all of the headlines. But the overview on the primary market and the quality of issues that we're seeing right now when we're in the middle of this debate on whether retail investors are helping early investors cash out.
I wouldn't disagree with that. I would say that some of these companies which are coming up for listing are promising companies for the future. But today, the valuations are primed up very punchy, though they have moderated in the last 6 months. We've been writing about IPOs, that at the IPOs, companies are definitely getting priced punchier in the marketplace, but at the same point in time, we've seen some moderation, not getting into a single stock discussion.
Well, I'm not expecting a single stock discussion at all, Nitin. It's just the idea of is it because there's that amount of liquidity in the market, domestic investors coming in, even mutual funds looking at options to put out their money and where to put their money, that some of these IPOs are getting the kind of valuations or commanding the kind of valuations and oversubscription that they are.
No, I completely agree. I think we have written that and we have shared that before also, that in India, most of the flows which are coming with the mutual funds are all going into the primary market, whether it is QIPs or IPOs, or even sometimes the block sales by OFSs. So most of the money is going there. It's not going to the present cohorts, and hence you've seen the markets plateau out at the same time. But valuations have moderated, but definitely many of them are priced very punchy for possible valuation, possible business fundamentals that could play out over the next 5-7 years.
Priced very punchy. Okay, that's a nice way of saying expensive. Thank you so much, Nitin, for speaking with us.